with the author of this note coming in, an important HSBC upgrade coming in on the Indian economy and the Indian markets. We have joining with us Herald Linde, the head of equity strategy at Asia Pacific HSBC. Herald, hi, morning, and thanks so much for your time. It's an interesting note you've got there, an upgrade coming in for India, and you've also called India to be the quiet space amidst all its pan-Asian peers. Give us your take on what is boosting this optimism, and especially the 94,000 target for Sensex by the end of next year.
Well, thank you, and good morning to you as well, and thanks for having me on. India is a quiet corner. If you look at, I think with one of your previous people that you interviewed, you were talking about how concentrated the US market is. So it is with Asian markets. They're also super concentrated. Where are people concentrated? They're in Korea and in Taiwan, because that's where the AI story to a large extent is unfolding, and China to a certain extent maybe as well. But if you look at, for example, just give you a bit of backdrop, Hynix in Korea is now the second biggest overweight for all funds, gem funds globally. TSMC, the largest stock in Taiwan, most funds have about 10% of their portfolio in that particular stock alone. So it's a really concentrated bet. And where do they not go to? And that's India. They've sold India. They've reduced their weightings on India. And our suspicion is that that's going to reverse. That people are going to go back to India and that they actually take money, not so much out of China, but I think maybe out of Korea or a little bit out of Taiwan as well.
But Herald, what is the view on India when you compare it with other emerging markets? I mean, the likes of China, Korea, Japan, or rather some of the developed markets as well, like Japan, Argentina, what we're seeing in that market, or some of the other South American markets as well. Because the concern for India has always been the earnings slowdown, a lot of the money actually moving to the primary markets as opposed to finding its way into the secondary markets, and valuation when it comes to India always seems to be a concern.
You're rightly saying always a concern. There's a very good reason for it, or a couple of reasons. One, Indian companies belong to the most profitable on the planet, so they deserve a premium. Secondly, India also has sort of capital control, so you get a sort of how do you say that? You get an effect where the money can't leave, and therefore it pushes these valuations on. So we have to take that into consideration. The earnings story in India is different, and I actually think it's not that bad. Yes, earnings are being downgraded. We actually became cautious on India exactly a year ago when we felt that earnings expectations were way too high. And then we looked at, say, 2025 as people thinking 18% earnings growth is not going to happen. So we felt there was a risk. This is why we were cautious for the last 12, 14 months or so. But now these earnings have already been cut. So instead of 18%, they're looking at 11 or 12%. We think probably is going to bottom out at about 8 or 9%. Next year, the number's 15%, a bit too high, but probably 13 might be achievable. So we're very close to the bottom of the earnings growth cycle. That doesn't mean it's going to turn around very quickly. It might take a couple of quarters, but you can see that the levers that are going to drive that recovery are there. You see lower interest rates, you see fiscal stimulus. So I think that the story in India is gradually moving in the right direction. While 12 months or 14 months ago, we felt everybody liked it at the time, we felt there was a bit too much euphoria, and now it's almost the opposite.
Right, okay, so that's the take coming in. Herald, I've been going through your note, and I notice you have an underweight coming in on the Japanese market. Now, with the way the Nikkei has performed recently, consistent all-time high, fresh highs coming in for the Nikkei almost every day now for the last couple of weeks, are you going to be changing the way you are viewing the Japanese markets anytime soon?
No, I think the Japanese market is to a very large extension a reflection of what happens with the yen. There's also corporate governance change, a couple of other things, but the yen is one of the key drivers there. And a weaker yen is good for the market, and a stronger yen is not so good for the market. And on the margin, we think the yen is not really going to strengthen that much, but a little bit more. Also, investors have taken the incremental dollar that they can invest and have not put it into the US, but into Europe and Japan. So they build up positions there. And I think as we go into the latter part of 2025 and in 2026, that money might start to flow into emerging markets, which is also, again, a positive for India.
The other thing that I wanted to talk about, Herald, when it comes to India especially, is that still overhang of the 50% tariffs that have been imposed on India. A resolution could come about. We don't know when, and we don't know the nature of that resolution. How significant is the impact of these tariffs on the Indian economy, you think?
Yeah, so these tariffs, I also have no idea where they're going to go to. If I have to I have to make a guess, or I have to say they're going to go up or down, I think they're going to go down from here. But I'm not a political analyst, so it's not that I have any particular insight into that. So we'll see. But the market knows this, so this is priced in. So we are aware of that. Also, the actual impact of that tariff on the earnings in India is limited because the vast majority of Indian companies sell their products domestically. They sell shampoo or jewelry or cars in the domestic market. They are not really impacted by these tariffs. The ones that are impacted are the ones, of course, that export to the US. But some of your sectors are being excluded from this as well. So the actual impact on earnings is not as big. It is just a sort of sentiment thing that hangs over the market. And if these tariffs would come down, yeah, that sentiment would improve. But let's wait and see until that really happens, because yeah, we just don't know when that takes place. So I'm not overly concerned about this. I'm really looking at what in the longer term drives equities, and that's really domestic interest rates, global interest rates, and the earnings in the market. And all of these factors look pretty okay for India at the moment.
Right, Harold, I want to talk to you about the foreign fund flow activity that we've been seeing in the Asian markets. Year to date, these markets are up on an average about 20% despite FIIs largely being sellers, as has been the case with the Indian markets as well. What do you think the concern here is? Is it fundamentals? Is it elevated valuations? Is it policy? What could be the hold-up here, and are you seeing this trend reversing anytime soon?
No, I think what has happened in large parts of Asia, India might be a bit of an exception to this, but what's happened in large parts of Asia is that a lot of people think in particular about China over the last couple of years. China was going through a very difficult rough patch. What do? You don't do anything with your money. You don't invest. Because your property was going down, your stocks were going down, you might lose your job. So what did people do? They put their money in the bank and didn't do anything with it. Indeed, that was the best decision to do, because in China you got deflation as well. That means your dollar today is worth even more tomorrow because prices are going down. You can buy more with it tomorrow. So that's what they've done. And now an enormous amount of cash is sitting on these balance sheets in China, on the banks. These households hold about $22 trillion of cash, of which we think $6 trillion could be invested in equities or bonds, or bonds don't give you any money. So equities, gold, property, anything else they want, crypto for my part. And we're starting to see this gradual reallocation, and that's going to be, supporting these markets. So that's one thing. And you see that similar sort of thing whereby the locals are coming out and trying to put their cash at work. You see this a little bit in Korea as well. You see this in Taiwan to a certain extent. ASEAN so, not so much. And in India, that has been a key driver. So in that sense, what we see in other parts of Asia, we've seen in India over the last couple of years. And I think those domestic buyers in India, they will eventually come back into the market as well.
Interesting. So, Herald, in lieu of your target on India Sensex over the next 1 year, I wanted to understand, where do you see leadership amid sectors? And would you say that financials will be the one driving the rally? Or could it be some of the other consumption plays?
There's a couple of interesting domestic sectors I would be looking at. I mean, selected banks don't look overly expensive to me. You see a little bit of consolidation in the cement industry, so that's where I would look at. Some of the consumer names in India look pretty good. Some of the mall operators, for example, as well. And one of the stories I really like in the medium term for India is medical tourism. Medical tourism is already a really big thing in parts of Asia. I think in India, it is just starting, that foreigners go to India for some kind of surgery, for some of your hospitals. I suspect actually the foreign contribution is at best maybe 5% or so or something of sales. But it's a really big thing in Singapore now, in Malaysia, in Korea. Korea is really good on plastic surgery and these sort of things. People fly from Indonesia to Korea to get a couple of injections into wherever they want to change, right? And why not then fly to India to get I don't know, if you need to do something on your lungs, your heart, or anything else. So that's something I would be looking at as well, hospitals.
So looking interesting in medical tourism, of course, emerging as one of the key new tourism sectors. But Herald, when we spoke about Japan, you spoke about concerns around the yen and the entire yen carry trade that we've been seeing. But if you shift focus to India, the rupee is also losing ground against the dollar. What do you have to make of the currency back home, and where do you think that trade is headed?
So the key difference between India and Japan in the sense is that Japan is an exporting stock market. The vast majority of companies listed on that market are exporters. Think about some of the electronic giants and the auto companies. They sell, of course, in Japan, but the big market is really the US and Europe, China. And that means if you have a weaker yen, that's good for them. So the weaker yen is supportive to the equity market. In India, it's always the opposite. A weaker yen is not necessarily that bad, but most of your companies are domestic-oriented companies. Exporters are a much smaller part. It's mostly, as you know better than I, the pharma and some of the IT companies. So the dynamics in that sense are very different. Also, the way Japan manages its currency is very different than India does. So Korea and Taiwan is the same. So the dynamics are very, very different. In India, you might get a weaker rupee. I'm not overly worried about that. As long as the valuations are cheap enough, we know that in US dollar terms, you can make good money as long as your entry point, your valuations is pretty good. And I think that's where we are now. Entry points are good when people don't like the market, they're underweight. But we see signs that things are starting to improve. It's that sort of inflection point where I think India is at the moment.
Okay, Herald, great chatting with you. Thanks for your time today.
Thank you for having me.